Hello students, this is C. Arpita here. We'll be learning the direct tax, IPCC direct tax amendments for the November 2017 exams. I have tried to compile all the important amendments from the May 17 RTP as well as November 17 RTP. They are very simple. Let us learn them quickly.
You can download the notes for this lecture from our website, that is www.commerceeduworld.com. Let us do it chapter wise. First we'll be doing the basic concepts. Check what is the first amendment. It was a very nice amendment. You must have learned in the first chapter the basic exemption limits, that is the slab rates. You remember doing the slab rates? If there was an individual whose age is less than 60 years, the basic exemption limit was rupees 2,50,000. If the age is between 60 years to 79 years, then the limit was increased to rupees 3 lakhs. Now suppose, let me give you an example. Suppose if there is an individual who is going to turn 60 years on 1st April 2017. His birthday will be on 1st April 2017 and on this date he is going to turn off 60 years. Now since you are giving November 17 attempt, we are doing for previous year 2016-17. But the birthday that I have given you, that is 1st April 2017, this falls in the next year. So now just tell me what will be the basic exemption limit that will be applicable for the previous year 16-17. Your answer will be, ma'am, since in 2016-17 he is still of 59 years of age, so the basic exemption limit will be of 2,50,000. But now your Income Tax Act has come up with an amendment that if that person is going to turn 60 years on the very next day of the year ending, see the year will end on 31st March 2017. On the very next day if he is going to turn off 60 years, then he will get the advantage that the basic exemption limit will be of rupees 3 lakhs instead of rupees 2,50,000. Now here I just gave you an example of senior citizen. Similarly, we can apply this provision for very senior citizen. You would have learned that if the age is 80 years or more, then the basic exemption limit of rupees 5 lakhs is applicable. So if a particular person is turning off 80 years on this particular date, then the basic exemption limit of 5 lakh will be applicable instead of basic exemption limit of 3 lakh rupees. Now a doubt will come, ma'am, what if the birthday is on 2nd April 2017 or any further dates? Then the exemption is not available. The exemption is available only if the birthday is on 1st of April 2017. Very clear with this? So this is a benefit which is given to the senior citizen as well as super senior citizens. This was one amendment in this chapter. The second amendment, a very important amendment of the chapter is, before this amendment we used to learn a section called as section 115 BBE, which talks about taxability on undisclosed income or income from undisclosed sources or unexplained investments. Whenever there is some undisclosed income, government always penalizes us. It always gives us punishment. Till now, the punishment was on the undisclosed income. We were supposed to pay a flat tax rate of 30% plus surcharge if applicable. Why did I say if applicable? Because the surcharge is applicable only when the total income exceeds rupees 1 crore and cess is anyways always applicable. So this was the punishment that we were getting till now. Till now means till assessment year 2016-17. But now there is an amendment in this section from assessment year 2017-18, that is the year which is applicable for your exams. Check what is the punishment that they have given you. See, up to assessment year 16-17, there was a tax of 30% plus surcharge if applicable, and there was a cess of 3% on the unexplained or the undisclosed income. But now this section has been amended from assessment year 17-18 to provide for levy of tax at the rate. Check, the rate of tax has been doubled. Instead of 30% it's now become 60%. Surcharge is at a very different rate. Surcharge is at the rate of 25% of the tax, that is 60% into 25%. And after that obviously there will be a cess of 3%. So after taking the effective rate of all these 60%, 25% and 3%, the effective rate of tax is 77.25%. Earlier it was 30% basic tax plus surcharge if applicable and cess of 3%. Now it is tax of 60%, surcharge at the rate 25% and cess is at the rate 3%. This is for undisclosed sources of income and this amendment has come into effect from assessment year 2017-18. But now what is same in the section, what is common in the section even after the amendment? Before the amendment, we were not allowed to take the benefit of basic exemption limit from this undisclosed income. You cannot subtract the basic exemption limit from this undisclosed income. The same thing continues now. Second thing, you are not allowed to take any deduction of expenses from this undisclosed income. You cannot go and tell to the assessing officer that, sir, I have incurred so and so expenses to earn this undisclosed income. That expense is totally disallowed. And the last one, you cannot set off any previous year's losses or current year's losses against this undisclosed income. So 3 benefits which are still denied to you is, first one, you will not get the benefit of basic exemption limit. Second one, no expenses are allowed from this income. And the third one, no set off is allowed. These 3 points are same. These were there before the amendment as well as these are there after the amendments. Very clear with this? So now let's go to the next one. The next chapter. In your book is residential status and scope of total income. There is no amendment in the RTP for residential and scope of total income. Now let's go to the next one. Incomes do not form part of your total income. This is your section 10 chapter, the exemptions chapter. In this, there were 2 amendments basically. First one is in section 14A. Let's check the heading of section 14A. Disallowance of expenditure in relation to exempt income. Disallowance of expenditure in relation to exempt income. First of all, here you are earning some exempt income which is exempt under any of the series of section 10. For that particular income, you have earned some expenditure, you have incurred some expenditure which is getting disallowed. Disallowed under section 14A. See, this is very logical. You are earning an income for which the government is giving you an exemption. So now you cannot claim an expenditure for such exempt income. If you claim such expenditure, then that expenditure will be disallowed under section 14A. And the government and the income tax department has given the limits. The expenses will be disallowed up to so and so extent. Now let us check what is that limit. The expenditure in relation to the income which does not form part of the total income shall be aggregate. Aggregate means total of the following, namely the amount of expenditure directly related to the income which does not form part of total income. Which does not form part of total income means the exempt income. Means you have incurred some expenditure which is directly related to this exempt income. Means first thing that is disallowed is the direct expenditure. Next thing, see now this is a static formula. An amount equal to 1% of the annual average of the monthly averages of the opening and closing balances of the value of investment, income from which does not or shall not form part of total income. Income that you are earning here, this is an income from investment. You have to take 1% of something. Now what is that something? Check again. Annual average of monthly averages. You have to take, see now 12 months are there in the year, April, May, June, July and so on. You have to go to the month of April, check the opening balance of the investment and closing balance of the investment, take an average. Now this average that you are getting, this is the average of the month April. Similarly, you have to do the same exercise for all the other 11 months. You will get 1 month figure of each month. So in all now you have 12 figures. Of this 12 figures you have to add up and take the average. That is, add up all the 12 figures divided by 12. This is your average investment. Of this average investment, how much percent is disallowed? 1% is disallowed. And now the second one is 1% of this average investment. Out of these two, which one is disallowed? They have not given you an option that first one is disallowed or second one is disallowed. They are telling you that first one and the aggregate, that is plus the second one, will be disallowed under section 14A. Now check. Suppose if this 14A figure comes to rupees 30,000. But the amount that I have actually charged to my P&L account, the amount for which I have taken a deduction is only rupees 20,000. Then how much will be disallowed for me? The limit is 30,000, but the actual expenditure which I have claimed as deduction is only 20,000. So I will get a punishment of only rupees 20,000. This is written here. Check what is written in the bracket. Provided that the amount referred to in clause 1 and clause 2 shall not exceed the total expenditure claimed by the. This was the section number, this was section 14A. Now the next one. This was a very simple one. Earlier we used to study a section called as section 10.4, where a non-resident is earning interest from an NRE account. NRE account stands for non-resident external account, which is maintained in India. If this NRE bank account is giving any interest income to the non-resident, it was fully exempt for him under section 10(4). Now there was just a clarification regarding this non-resident person. Clarification regarding liability to income tax in India for a non-resident seafarer. Seafarer means a person on the ship receiving remuneration in NRE account maintained with an Indian bank. Means here there is a seafarer who has maintained an NRE account with an Indian bank, and now he is receiving his remuneration into this bank account. Earlier the exemption which I told you, that was relating to interest. Now we have already studied in the chapter 2, that is scope of total income, that any income earned by a non-resident in India will be fully taxable. But now here first we'll have to check from where is that non-resident earning the income. Check what is the clarification all about. The CBDT has by this circular clarified that the salary accrued to a non-resident seafarer for services rendered outside India on a foreign going ship with, this is irrelevant, with Indian flag or foreign flag shall not be included in the total income merely because the said salary has been credited in the NRE account maintained with an Indian bank by the seafarer. What are they trying to tell you? If there is a non-resident who is earning any income because he has rendered services outside India, that income is not treated as an Indian income. But what if he has deposited that remuneration in an Indian bank, that is in an NRE account, then too he is eligible for the exemption. This income which is earned outside India will not be taxable in India. Next one. The next chapter is PGBP, the very important chapter, profits or gains from business or profession. In this, there were 4 small amendments. Let us just have a glance on them. First one was a very simple one. You understand non-compete fee? What do you mean by non-compete fee? Suppose somebody comes to me and tells me, ma'am, you close your classes, you shut down your classes, I'll pay you 1 crore rupees for that. Why is that person ready to pay me just because if I'm closing my classes? Obviously he has some fear of competition. So just to avoid competition, he is telling me to shut down the classes, for which he is telling me that he will be paying me a sum of rupees 1 crore. Now the sum of 1 crore rupees that I will be receiving from him will be taxable under which head? Earlier there was no such clarification, but now there has been a clarification by the CBDT that this non-compete fee will be taxable under the head PGBP. Non-compete fee will be taxable under the head PGBP. That is one thing. Second thing, you remember something called as additional depreciation? There were 2 types of depreciation. First one was normal depreciation and the second one was additional depreciation. Normal depreciation is available to all, but additional depreciation is available only to the SSCs who are engaged into manufacturing, and that too if they are purchasing any plant and machinery which is to be installed in the factory premises. So now this benefit of additional depreciation has been extended to few people. Let us check to whom have they extended this provisions to. Assessors engaged in the business of transmission of power. Transmission of power. Earlier it was only power generation. Now it is also to the companies who are just into transmission of power. Even they are eligible for additional depreciation. And second one, check the last thing on this page. The assessors who are engaged in the business of printing or printing and publishing. Even these people are eligible for additional depreciation for the plant and machinery that they are purchasing for their business. So now since the additional depreciation claim has been extended to him, it is beneficial for the assessee because now they can charge additional amount of depreciation in their tax books. And whenever I say depreciation, one section should strike you, and that is section 32. Next one. Remember something called as section 32 AD? 32 AD was again a benefit given to the assessees who are setting up new plant and machinery in notified backward areas. There were some name of the states given earlier, Bihar, Telangana, etc. etc. Now there is no amendment in the section, but they have included in those specified areas, they have included few more areas which have been listed in the RTP. Few more cities, few more states have been listed there. But along with that, along with the name of these states, they have also given one clarification. However, students are not required to learn exactly the names of such notified areas. So they are just trying to tell you that some notified areas have been included in the list, but you are not supposed to remember those names. They will specify in the question whether it is a notified area or not. Okay. Next one, a very simple one. Earlier we used to study a section called as section 35 ABB. 35 ABB was for telecommunication license. Telecom companies were supposed to purchase license to run their business. Now this license was treated as an intangible asset. So there were two options. Either you can claim depreciation on intangible assets under section 32, that is the normal depreciation. Or alternatively, you were allowed to take benefit under section 35 ABB, which is as good as the SLM basis. But that deduction was for the cost of the license that was purchased. Now a similar section has been inserted, very similar section, section 35 ABA. Just check the heading of section 35 ABA. It is tax treatment for spectrum fee. Now you must have heard something called as radio waves or airwaves. It is one of the way through which we can communicate. That is, the lines, the connection is made through radio waves or the airwaves. So every telecom company is supposed to make the payment for this radio waves or airwaves to the government. Earlier also for the telecommunication license we used to make the payment to TRAI, that is TRAI, Telecom Regulatory Authority of India, something like that. But now you have to make you are not again supposed to make the payment for the license fee, but now you have to make the payment for purchase of those airwaves or radio waves. Now even those radio waves and airwaves are intangible assets. You again have two options. Either you can claim depreciation under section 32 as intangible asset, or you can claim deduction under section 35 ABA. Now the tax treatment, how is the deduction supposed to be claimed in every year? That method is same as section 35 ABB. The only difference between 35 ABB and 35 ABA is 35 ABB was for purchase of telecommunication license and 35 ABA is for payment for airwaves or radio waves, that is, which is termed as payment of spectrum fees. Very clear with this? Let's go to the next one. 44 AD, a very superb amendment done in the section 44 AD. You must remember section 44 AD. In 44 AD, there was something called as presumptive taxation, which was applicable for business. Now, there was a deemed taxation that people who are following section 44 AD, that is assessees, business assessees whose turnover does not exceed rupees 2 crore, were allowed to show a deemed profit of 8%. That is, the turnover into 8% will be the deemed profit. This was there in section 44 AD. But now a small amendment has been made in section 44 AD after demonetization happened was, if you are receiving, if first of all you must follow the presumptive taxation of section 44 AD, and if you are receiving any amount by digital way, that is, it can be check, it can be electronic mode, or I can say any mode other than cash. On those receipts, the deemed profit will be equal to 6% of such turnover. Now what do you mean by 6% of such turnover? Such turnover means the turnover which has been collected in any mode other than cash, or we can say any mode of digital way. So ma'am, what does this mean? Will the 8% rate be totally irrelevant now, or 6% will be the new rate, or what? See, both the rates will be into action. 8% will be on that turnover which is collected in cash, and 6% will be on that turnover which is collected by any mode other than cash. Very clear with this? This is a very important amendment. You can expect this amendment in the exams also. Next one. Check what is the next one. Admissibility, a very simple amendment. Admissibility of expenditure incurred by a firm on keyman insurance policy in case of a partner. Now we have already studied about keyman insurance policy before. Keyman insurance policy means a policy taken by a company on the life of its KMP. That suppose if the company feels that if this particular person, something happens to this particular person, then the company might go into losses. At that time the company takes a keyman insurance policy on the particular of that person's life. Similarly, a firm, a partnership firm or a LLP can also take keyman insurance policy on any of its partner. If the firm thinks that this partner is so important, he is handling all the operation, if he goes away, if he passes away or something like that, a huge loss can happen to the firm. In that case, the firm will take the keyman insurance policy on the health, on the life of the partner, who will be be paying the premium now? Will the partner pay the premium or the firm will pay the premium? Obviously the firm will pay the premium. Now that premium for the firm is an expenditure, and that is an allowable business expenditure under section 37(1). 37(1) was the section of general deduction. So now the premium paid on the key man insurance policy is fully allowable under section 37(1). That is the amendment here. That is the more than amendment, it is a clarification. Now next one. Next one is again very simple. Check what is given there. Admissibility of deduction under chapter. Admissibility means the deduction is available under chapter 6A. 6A is ATC, ATD, all the deductions on the profits enhanced due to disallowance of expenditure related to business activity. Now can you list a few sections of PGBP where the expenditure is totally disallowed? We had studied something called as section 40A3. Cash payments exceeding rupees 20,000. Then we had studied something called as section 43B. 43B was deduction based on actual payment. Similarly, we had studied a huge list of section 40A where the TDS is not deducted, where there was a default of TDS. In all these cases, it attracts disallowance. If it attracts disallowance, can I say my taxable profits will increase? Now, from these taxable profits will first of all form part of my GTI. Now, from this GTI, will I get deduction under chapter 6A? That was the question. Now, first of all, why did the question arise? Will I get deduction under chapter 6A? The question arises because the profits have been increased, not because I have earned something, because some amount has been disallowed under some of the provisions of PGBP. Now, disallowance is adverse because you have to pay more amount of tax. But chapter 6A says, I don't care. Even if PGBP has disallowed some few amounts in its head, the assessee will still get the deduction of chapter 6A. Very clear with this? So, even if there are some disallowances under few sections of PGBP, deduction of chapter 6A will still be available. Next one. Next one was very simple. You understand something called as bad debts, right? Now, bad debts is an business expenditure. Bad debts is obviously a business expenditure, but we had learned in section 36(1) that provision for bad debts or provision for doubtful debts is totally disallowed because it is just a provision. So, which figure is allowed as deduction? The provision is allowed as deduction or the actual bad debts are allowed as deduction? Obviously, the actual bad debts. Now, how do you prove that this amount is an actual bad debts? When will you write off the bad debts from your books of accounts? When you feel or when you are reasonably sure that the money is not going to be received from the debtor, at that time, will you create a new provision for doubtful debts or will you write off the bad debts? We will obviously write off the bad debts if you are sure that the money will not be received. At that time, that amount of bad debts will be totally allowed as deduction. You are not supposed to prove to any income tax authority that this amount is irrecoverable. If you just pass a book entry in your books of accounts of writing off, not of provision, of writing off the bad debts, it means that is your actual bad debts and actual bad debts will be allowed as deduction. Very clear with this? Next. Next one was a very simple one. Now just check the heading of the next one. Lease rent from letting out buildings, developed space along with other amenities in an industrial park or SEZ to be treated as business income. Now we have already studied that rent income is already taxable under the head income from house property. But here the company is receiving lease rent, that is rentals, again from some person because I have provided some facility. First of all, I have provided space in a particular area in an industrial park, and plus I am providing some extra amenities also. In that case, if I am receiving the rent from the other person, that will not be taxable under the head income from house property because that is not a house property. It is a commercial premises where the business is going to be done and not somebody is going to stay in that premises. So from that, if I am receiving any lease rent, see now here if I am receiving any lease rent, that lease rent is a part of main business. And if it is a part of main business, that lease rent will be taxable under the head PGBP and not under the head income from house property. This is again a very important amendment. Again, more than amendment, it is a clarification. Next one. So we are done with the PGBP amendments, and the next one is capital gains. There was only one amendment in capital gain. First one is very simple. Check here. The CII, the cost inflation index for your exams, that is 2016-17, is 1125. You just have to remember the CII of 2016-17, 1125, and of the base year, that is 1981, 100. Okay. Now check the next one. A very simple amendment done by them. Just check the heading. We may not read anything within that. Clarification on taxability of compensation received by the landowners. Landowners are receiving some compensation. We usually receive compensation only from government whenever there is a case of compulsory acquisition. Compensation is received by the landowners for the land acquired under the right. Government had acquired our land under so and so act. There is some special name of the act given here. In short, we call it as RFCTLARR Act. If you receive any compensation under this act, just try to understand one small thing. If you receive the compensation under this special act, this special act says that it is exempt from income tax. It is not told in the Income Tax Act. It is told in that special act itself that the compensation received by the landowners will be totally exempt. Similarly, we have to apply the same point in the Income Tax Act. In Income Tax Act also, if you receive any such compensation, the entire amount will be exempted. I agree that there is no provision in the Income Tax Act about it. But for this special case, you have to go and check that special act. In that special act, it is anyways exempted. So Income Tax Act also says that the amount received as compensation by the landowners under the special act will be fully accepted. Very clear with this? Just check the name of this special act. Right to fair compensation and transparency in land acquisition, rehabilitation and resettlement act 2013. If you receive any compensation under this act, then the entire compensation will be accepted. This was the only one important amendment in capital gain chapter. Now come to the next one. IFO is one small amendment in this. Check what is the amendment. Shares received by an individual or HF as a consequence of demerger or amalgamation of a company or business reorganization of a cooperative bank not to be subject to tax by virtue of section 5627. 5627 is that of the gift taxation. Now here demerger is happening or amalgamation is happening. Can I say in case of demerger, I'll have to give up the shares of demerged company and I'll get the shares of resulting company. For the shares of resulting company, I'm not paying any amount because anyways I'm surrendering the shares of demerged company. This is not treated as gift. Just because I'm not paying anything to the company doesn't mean that I'm receiving the shares as gift. So gift taxation is not applicable when such exchange takes place. Okay, next one, one amendment in the deductions from GTI, that is we are talking about chapter 6A. In the last supplementary, we had studied about section 80JJAA, which gives exemption to a manufacturing company who is liable for tax audit under section 44AB and who is employing new workmen in the year. If you employ some new workmen in the year, can I say your wages cost will increase if you are in the manufacturing concern? If your wages cost is increasing, you will write those wages cost in the trading account. You will get the deduction for that. Plus you were getting some extra deduction at the rate 30% of this additional employee cost. This we had already learned in the supplementary before. Now what is the amendment in this? Check the amendment. Relaxation of minimum period of employment. If you want deduction under this section, that employee should work in your company for at least 240 days during that previous year. If he is working for less than 240 days in the previous year, he is not treated as an employee and therefore for his salary, we will not get any extra deduction of 30%. But now, for assessees who are engaged into apparel business, that is cloth business, which is a seasonal business as they say here, instead of 240 days, they have reduced it from 240 days to 150 days. Ma'am, does that mean the entire section, in the entire section the number of the days has been reduced to 150 days, or is it only for this business? It is only for this apparel business, which is a seasonal business. For this, the number of days has been reduced from 240 to 150. For rest all the business, the number of days still remain the same, that is 240 days. Now next, provisions concerning advance tax and TDS. Very simple. Check what are the amendments in this. First one is very important and very nice clarification. It is on section 194I. We have already studied section 194I. 194I is TDS on rent, where I am taking any premises, any land or building or plant and machinery on rent. I will be paying rent to the other person. If I am paying rent of more than rupees 1,80,000, I am supposed to deduct TDS from that. There are two rates of TDS in that section. You can just go and refer that. One is 2% and the other one is 10%. Now the clarification is on what? Now suppose I have taken this premises on rent. I am going to my owner. I am telling him, sir, I want this premises for a long-term period. Assume I want this premises for 20 years. You cannot ask me to vacate this property before 20 years. He said, okay Arpita, no problem. But for this, you have to pay me a lump sum premium of 1 crore rupee, so that I don't give this premises to anybody else on rent. I agreed. I said this premises is very good. So now I am ready to pay the lump sum premium of rupees 1 crore. Now again, the tenant will be paying this 1 crore rupees to the owner. My question is TDS applicable on this 1 crore rupee? You got my question? I am not paying a rent of rupees 1 crore. I am paying a lump sum premium of rupees 1 crore. And will TDS apply on this 1 crore rupees? The answer is no. This 1 crore rupee is not in nature of rent. This 1 crore rupees is just a lump sum premium which is non-refundable. On this 1 crore rupees, TDS is not at all applicable. This was a clarification. Again, a very important clarification which can be seen in your question paper. Next one. This was a very simple one. Section 197A. See, whenever we pay any amount to banks, say for example, whenever we do NEFT or RTGS, bank charges some amount. Whenever bank provides guarantee to us, bank charges bank guarantee commission. We pay this amount to the bank. Do we deduct TDS from the amount that we pay to bank? We never deduct TDS from whatever amount we pay to the bank. So that is the same clarification. Check what is written there. This section provides that no deduction of TDS shall be made from such specified payments made to institution, association or body or class of institution, association or bodies as may be prescribed by central government. CG has notified that no TDS made by a person to a bank listed in a second schedule to RBI Act excluding a foreign bank, means whenever we are paying to foreign bank, this section is not applicable. Check what are the specified payments. They have just listed the example: bank guarantee commission, cash management service, demat account service charges are there, warehousing services for commodities, underwriting service charges, MICR charges, that is check clearing charges, credit card or debit card commission, etc. These amounts are paid by the customer to the bank. From this amount, the customer is not supposed to deduct any TDS. That was a clarification. Next one. Next one was again a very good section. Section 206AA. You have already studied this section before. 206AA says that whenever I am deducting somebody's TDS, I am supposed to take PAN of that particular person, that is of the deductee. The deductor is supposed to take the PAN of the deductee. What if the deductee is not providing me with the PAN? If deductee is not providing me the PAN, I will deduct TDS at a higher rate. There were 3 points given. From those 3 points, we were supposed to take whichever is higher. First one was the rate applicable, that is as per the TDS. Next one is the basic rates which we have studied in the Finance Act. And the third one is 20%. From these three, we were supposed to take whichever is higher, and in most of the cases, not all, but in most of the cases, we used to get a higher TDS rate of 20%. Now in this case, the other person is getting a punishment. If suppose that person was liable for TDS under section say 194J, that is professional services. As per the normal rates of TDS, the TDS was deductible at the rate 10%. But now since the other person has not provided me with the PAN, I am supposed to deduct his TDS at the rate 20%. Now this is okay. What if I am making any payment to a non-resident? Suppose if there is a non-resident, obviously he will not be having PAN of India. In very exceptional cases, the non-residents are having PAN of India. Now, then in that case, am I supposed to deduct TDS at higher rate or am I supposed to deduct TDS at normal rates? The non-resident is not having his PAN. See now, it is not written anywhere that the non-residents are compulsorily supposed to take PAN. If if they are not required to take PAN? Obviously they will not take PAN if it is not compulsory. So in that case, if I am making a payment to non-resident, I am not supposed to deduct tax at higher rates. I have to deduct tax as per the normal rates of TDS. But in return, since his PAN is not available, I will be taking basic information from him. Check what are the basic information. His name, email ID, contact number, the address in that country in which he is residing or in which he is doing his business, then a certificate of his resident in any other country. We have to take a certificate that he is a resident of that particular country. It is known as tax residency certificate. That this we will study in CA Finance, tax residency certificate. And we'll have to take some tax identification number. Like in India, for income tax, we have a tax identification number called as PAN. Right? Same way in the other country also there is something called as tax identification number. So we have to take all this information from the non-resident. If we take all this information from the non-resident, we are not supposed to deduct the TDS at higher rates. This was an amendment in section 206AA. Now, the last one, last chapter. Check what is that? Very nice amendments done again. The name of the chapter is Provision for Filing Return of Income. In this, the first amendment. Now, the government is obviously promoting physical filing of return of income or e-return filing. Obviously, e-return filing. Okay. Now, suppose if there is a particular assessee who knows what are the tax provisions, how to calculate the total income, how to calculate the tax, but does not know how to file the e-return. Then there is a person called as e-return intermediary who will come into picture. What will this e-return intermediary do? He will just collect the data from whom? He will collect the data from the assessee. He will digitize this data. Digitize this data means convert the manual data into electronic form and submit the return electronically. By this, what is happening is the assessee is able to file the e-return instead of manual return through whom? Through an e-return intermediary. Now, who can act as an e-return intermediary? Check, they have given you there. Qualifications of e-return intermediary, very simple. A form of chartered accountants or a CA. A form of advocates or an advocate. A form of company secretary or a company secretary. A form of cost accountant or a cost accountant. And lastly, a tax return preparer. These people can act as an e-return intermediary provided they must be allotted a PAN, because in that return they have to also submit their own PAN. Very clear with this? So there are 5 people who can act as an e-return intermediary. First one is a chartered accountant or a firm of chartered accountants. Next one is company secretary or firm of company secretaries. Advocate or a firm of advocates. Cost accountant or a firm of cost accountant. And lastly, it is a TRP. These people can act as an e-return intermediary. Next one, second last amendment. Amendments made by the taxation laws. Very simple. Splitting up or reconstruction of an erstwhile public sector company. Splitting up or reconstruction of an erstwhile public sector company can be called as a government company into separate companies as a result of transfer of its shares by central government. Earlier there was a public sector company in which central government was holding some shares. Now central government has transferred its shares to some other person. Now this is also deemed to be a demerger because a particular person is selling off its stake. So this is treated as good as a demerger. This was one clarification. And the last one, very important. Now, after the demonetization has taken place, whenever you deposit your cash into bank, the bank will ask for PAN if you are depositing any amount above a certain limit. And this was applicable mainly for that particular dates, that is between 9th of November, it's written there, check, it's 9th of November, demonetization happened on 8th of November, we started depositing cash from 9th of November to 30th December 2016. If you deposit a particular sum of money, above a particular sum of money in the bank's account or in the post office, you are mandatorily supposed to quote the PAN. Now check what are the limits here. If you deposit with a banking company or a cooperative bank or with a post office, 3 people, normal banks, cooperative banks or post office, cash deposit exceeding, that is more than rupees 50,000 during one day, or aggregating more than rupees 2,50,000 during this period. This period means 9 November 2016 to 30 December 2016. Single day, single payment more than rupees 50,000, aggregate during this period more than rupees 2,50,000. you have to mandatorily quote PAN while depositing the cash in the bank. Very clear with that? Okay.
So this was all about the amendments, which were very short, very simple. If you do these many amendments, it is more than enough for your November 17 exams. So I wish you all the very best for your exams. And if you need any help on video lectures, if you wish to subscribe for any video lectures, you can call me on 9167082081. Also subscribe to our YouTube channel if you wish to see any free video lectures available there. Thank you so much.